right, ready to dive in. Today we're tackling Howard Marks' The Most Important Thing.
Oh, this is a good one.
It is. We're going straight to the source, using excerpts from the book itself.
Excellent.
And our mission, to pull out the most valuable insights for you, the kind that can actually make a difference in your investing.
That's the key, isn't it? Actionable advice.
Absolutely. Marks has some interesting stories, even compares picking investments to waiting for the perfect pitch in baseball. But we'll get there.
Looking forward to that.
Me too. But first, gotta lay the groundwork.
And a strong foundation is so important, right? Marx isn't just about understanding the markets. He wants you to outperform them.
Exactly. And that starts with something he calls second-level thinking.
Right off the bat, love it.
Second-level thinking. What does that even mean?
Well, it means you can't just stop at the obvious. Think about it. Everyone sees a company doing well. The first thought is buy the stock. But a second-level thinker goes deeper, asks, if everyone already thinks this company is great, isn't that already reflected in the price? Maybe it's even overvalued. They're not just reacting to information, they're thinking about how everyone else will react.
Taking it a step further.
Exactly. Like predicting the market's move before it happens.
Trying to be one step ahead.
Precisely. You got to recognize that the first level obvious thought is probably already priced in. Marx actually has this 2x2 matrix.
Okay, I like visuals.
You've got conventional behavior versus unconventional, and then favorable outcome versus unfavorable. The sweet spot.
Let me guess. Unconventional behavior, favorable outcome.
Bingo! That's where the superior returns live.
So second-level thinking is about finding those hidden gems, the opportunities that most people are missing.
Exactly. It's about understanding that the market isn't always perfectly rational. Our emotions, things like greed and fear, they create these little inefficiencies that a smart investor can capitalize on.
Makes sense.
This all ties back to that debate about the efficient market hypothesis. You familiar with that one?
Oh yeah, the idea that markets are really good at quickly absorbing all available information.
That's it. So in theory, it should be nearly impossible to beat the market consistently.
Right, if all information is already factored in.
And Marx doesn't completely disagree. He acknowledges markets are generally efficient.
But
Big but human behavior throws a wrench into things.
the human element.
Our emotions, our biases, our herd mentality, they create these pockets of inefficiency that a savvy investor can exploit.
So it's not that markets are never efficient.
Yo.
It's that they're not perfect.
Exactly.
There are still opportunities for those who can think differently.
Think about times of panic selling when the market takes a dip.
Everyone's running for the exits.
Right. And that creates an irrational market where assets might be severely undervalued.
A contrarian investor's dream.
That's where they step in while everyone else is running away.
So being contrarian, but with a reason.
It's about knowing when to zig when everyone else is zagging, but always backing up your decisions with solid analysis.
Makes sense.
Which brings us to a cornerstone of Marx's philosophy: value investing.
Value investing. I feel like I hear that phrase all the time.
It gets thrown around a lot, but what does it actually mean?
Yeah, in practice.
At its core, it's about focusing on intrinsic value, figuring out what something is really worth. A company, real estate, anything.
And then buying it for less?
When it's below that value. And selling when it goes above.
Buy low, sell high. Isn't that everyone's goal?
In theory, yes. But the hard part is accurately determining that intrinsic value. It requires a lot of analysis, understanding the business.
And discipline.
Absolutely, the discipline to resist getting swept up by market trends.
I can see how that would be tough when everyone's making money on the latest hot stock.
It's tempting. But Marx has a warning about that, a cautionary tale.
Oh, I love a good story. Lay it on me.
The Nifty 50? A group of blue chip stocks back in the 1960s, everyone was convinced they were surefire winners.
Really?
Investors were so enthusiastic, they bid up the prices to astronomical levels.
I'm guessing this doesn't end well.
Not exactly. Many were great companies, but the problem was they were priced for perfection.
So when things cooled off.
Early 1970s, the market cooled off, those stocks came crashing down, wiped out a lot of capital.
Ouch. So even a great company can be a terrible investment.
If you overpay, absolutely. Enthusiasm and momentum can't replace understanding value.
Good point. You always have to ask yourself, is this price justified?
Based on the fundamentals, yeah.
No.
Which, speaking of things that can hurt your portfolio, leads us nicely into risk. Marx has a pretty interesting take on that.
Does he ever? We'll dive into that right after the break.
Sounds good. Oh, he definitely does. You know that idea that higher risk means higher returns?
Yeah, kind of a classic investment thought.
He challenges that head on. Riskier investments just offer the potential for higher returns, no guarantees.
It's more like a chance.
Exactly. And he also goes after that traditional view of risk as just volatility.
Oh, yeah. A bumpy market equals high risk.
A lot of people think that way. But Marx says volatility might not actually be the biggest risk for most investors.
Interesting. So what else should we be worried about?
Well, he points out things like underperformance risk. If you're a professional investor, you know lagging behind your benchmark
Can't have that.
could be a career killer. And then there's career risk in general.
Taking a big swing and missing.
Exactly. A bet that goes south damages your reputation. Maybe you even lose your job. So the question is, how do we handle all these layers of risk?
Especially if volatility isn't the only thing we should be thinking about.
Well, Marx believes you can actually achieve high returns and low risk.
Really? At the same time.
It's a different approach, though. It's not about chasing those super risky, high volatility investments. It's more about finding those hidden gems that the market has mispriced.
Things that other people are too scared to touch.
Yeah. Often, those are the assets that offer the best potential. It reminds me of how he compares risk to germs.
Okay, how's that?
They're invisible until, bam, they hit you with a problem.
You don't know they're there until it's too late.
Exactly. And this leads right into his point about controlling risk. He makes it very clear that, yeah, control is essential, but avoiding risk altogether,
You'll miss out.
you'll miss out on potential gains, yeah. It's like if you never leave your house because you're scared of getting a cold.
You'll miss life.
Exactly. He even uses the example of life insurance companies.
Interesting example. How so?
Well, they're essentially betting on people dying, right?
Morbid, but true.
But they do it in a smart way. They understand the risks, they analyze them carefully, diversify across a lot of people.
So even seemingly safe investments have some degree of risk.
They do. It's all about understanding it, managing it, and making sure you're compensated for taking it on.
Intelligent risk-taking, not just hiding from it.
Exactly. And that's where his concept of market cycles comes in. He uses this analogy of a pendulum swinging back and forth.
Okay, I can picture that.
It's constantly moving between extremes, right?
So he's saying markets are always shifting, like between euphoria and depression, greed and fear.
Exactly.
Mm.
Risk tolerance and risk aversion. He warns about ignoring these cycles, thinking, oh, it's different this time.
Which we all know it never is.
Right. Just because things are great now doesn't mean they always will be. He even has these quotes from the 1928 market peak right before the crash.
Everyone thought the party would never end.
Classic example.
Yeah.
So the question becomes, how do we use this knowledge of cycles to our advantage?
Yeah, that's the million-dollar question.
It comes down to recognizing where we are in the cycle and adjusting our behavior. When everyone is euphoric, piling into risky assets.
That's when we should be cautious.
Exactly. And when everyone's panicking, selling everything.
Trying to look for bargains.
It's classic Buffett, right? Be fearful when others are greedy and greedy when others are fearful.
Words to live by, but harder to put into practice. Our instinct is to follow the crowd.
Absolutely. It's human nature, which is why Marx spends a lot of time on those negative influences, the things that cloud our judgment.
Like what?
Greed, fear, obviously, but also the tendency to ignore history. And then there's the allure of those silver bullets, the investments that promise huge returns with no risk.
Get-rich-quick schemes.
Exactly. Too good to be true. He uses the tech bubble as a prime example.
Oh, yeah.
People got so caught up in the hype, they forgot about the basics, drove prices through the roof.
And we all know what happened next.
Crash and burn. So we need to recognize these psychological biases. They affect everyone, even the pros. And we need strategies to combat them.
Strategies to stay rational, to avoid those emotional traps.
Marx is a big fan of contrarianism, going against the crowd.
Not just to be different, though, right?
Right. It's about having a reason why the crowd is wrong and the guts to stick to your own analysis. And this is where his approach to finding those bargains comes in.
It's not about chasing the hot trends.
No, it's about looking where others aren't, finding value in those assets that everyone else hates.
The unloved, the forgotten.
He talks about 3 specific areas where he's had success: convertible securities, high-yield bonds, and distressed debt.
Okay, those sound a little more complex than your average stock. What's so special about them?
They're often mispriced. Take convertible securities. They're a mix of stocks and bonds. People didn't always understand them.
So complexity creates opportunity.
Sometimes, yeah. He saw the same thing with high-yield bonds, issued by companies with lower credit ratings, right?
The so-called junk bonds.
Exactly. A lot of institutional investors wouldn't touch them, too risky.
But Marx saw an opportunity.
And distressed debt, same thing. Investing in companies facing financial trouble, maybe even bankruptcy.
Sounds scary.
It's not for everyone, but amidst all the chaos, there were often valuable assets being sold dirt cheap. Buy when there's blood in the streets.
That's a little intense, but I get the idea.
When fear takes over, rationality goes out the window. That's when the real opportunities appear. Remember that line from Marx. Investment bargains needn't have anything to do with high quality. Low quality scares everyone else away. That's when things get cheap.
So risk and return, they go hand in hand.
They do. If you're willing to venture where others won't, embrace those shunned assets, that's where you can find big returns.
But even finding those bargains isn't enough, is it?
No, you also need the conviction to actually act on your analysis.
Even when everyone else thinks you're crazy.
Which brings us back to those psychological traps. Marx goes into specific things that can sabotage our strategies.
Our own brains working against us.
One big one is the tendency to dismiss logic, history, and time-honored norms. It's that belief that it's different this time.
Like during the dot-com bubble.
Perfect example. People thought valuations didn't matter anymore. The internet changed everything.
Classic case of getting swept up in the hype.
It's a dangerous trap, fueled by greed and fear of missing out. And the media often makes it worse. They love to hype things up.
Instead of providing balanced analysis.
Right. Another pitfall is relying too much on shoulds instead of probabilities. We focus on the most likely outcome, what should happen, and forget that things can go wrong.
We become blind optimists.
Sort of. Marx reminds us, even when you've done your research, you feel good about it, unexpected events happen. He uses this analogy of a racehorse.
Okay, a racehorse. I'm intrigued.
Someone bets their rent money on this horse, and then what happens? The horse jumps the fence and runs away.
Talk about bad luck. So no matter how certain we are, things can go sideways.
Exactly. Investing isn't about perfect predictions. It's about building a portfolio that can handle those unexpected bumps. That's where that margin of safety comes in.
That buffer zone.
Exactly. And this is why understanding market cycles is so important. Knowing where we are in the cycle helps us decide when to be aggressive, when to play defense.
And of course, risk and return are always linked.
Always. And Marx is big on thinking beyond just volatility when we consider risk.
There's more to it than just ups and downs.
You got it. There's the risk of losing everything, underperforming, making decisions that hurt your career. He believes skillful investors can achieve high returns and manage all of that.
It's like a balancing act.
It is. He calls it asymmetry in performance, where the gains in good times more than make up for any losses in bad times.
So not just home runs, but consistent base hits, avoiding those strikeouts.
That's the idea. He even says to look at investors in environments that don't suit their style. Can the aggressive growth investor avoid giving back gains when the market cools down? Will the value investor participate when the market is soaring?
It's about showing that your process works no matter what the market is doing.
Marx believes those top investors have three key characteristics: consistent outperformance, smaller losses during downturns, and that asymmetry where gains are bigger than losses over time.
Sounds like more than just stock picking.
It is. It's understanding market psychology, managing risk, being patient, and sometimes it's going against the crowd, being a contrarian, and acting when you see a mispricing.
Marx also talks about acknowledging what we don't know, right?
Oh yeah, he doesn't believe anyone has a crystal ball, especially when it comes to those big macro events.
Trying to predict the economy or interest rates.
It's tempting, but he says it's too complex to get right consistently. Better to focus on what you can know. The fundamentals of specific companies, specific industries.
Sticking to the knowable. There's a big difference between analyzing a company and predicting the whole economy. And even with great analysis, there's always luck, right?
Absolutely. Not all success is skill. Not every failure is incompetence. Sometimes it's just the way the dice roll.
But we don't just give up, do we?
No way.
Yeah.
We follow a process, focus on what we can control, and keep learning.
Which brings us back to that idea of defensive investing.
Right. Not avoiding risk completely, but making sure losses don't wipe us out.
Protecting what we've got.
Marx puts it perfectly. If we avoid the losers, the winners will take care of themselves. Play the long game, be consistent, and let compounding do its thing.
It's like they say in sports, defense wins championships. So not just making the right moves, but avoiding the big mistakes.
Exactly. And as much as we've learned from Marx today, he keeps reminding us this is a journey.
Always learning, always adapting.
He encourages us to challenge what we think we know, find new information, keep refining our approach. That growth mindset.
Always evolving.
He also reminds us that there are no shortcuts in investing.
No get-rich-quick schemes.
It takes work, dedication, and a willingness to learn from everything.
Both the good and the bad.
And humility, too. Nobody has all the answers. The market will always find a way to surprise us. But by taking these principles to heart, the second-level thinking, the focus on value, risk management, being contrarian,
we can face those market uncertainties with more confidence.
That's what Marx gives us. Not just a set of rules, but a framework for thinking.
A set of principles to guide us through this crazy world of investing.
He wants us to be thoughtful, disciplined, and adaptable investors.
And that's the real power of his work, right? It's not just about making money, it's about understanding the game.
Making informed choices, building a solid foundation for the long term.
So as we wrap up, I'm left with one question, echoing Marx himself. Where do you think we stand in the market cycle today?
Ooh, that's a good one.
What signals are you seeing? Euphoria, high risk, abundant opportunity.
Every investor needs to wrestle with these questions. There's no easy answer, and the market loves to throw curveballs. But with those principles in mind, that second-level thinking, that focus on value, the risk management, the contrarian spirit,
we can handle those curveballs.
we can navigate the uncertainty and make good decisions. That's the essence of what Howard Marks teaches us, and the most important thing. It's about understanding those forces at play, making informed choices, building that foundation for success.
And that, my friend, is a wrap on another deep dive. Thanks for joining us. It's amazing how Marx emphasizes that investing is a journey, always learning. We've covered so much second-level thinking, value, risk, those psychological biases. But it's about putting it all together, isn't it?
It really is. It's not about mastering any one concept. It's about weaving them all together. He even says it himself. Successful investing requires thoughtful attention to many separate aspects, all at the same time.
It's like a chef, right? Creating their signature dish.
I like that. The ingredients, the technique, the timing, the way the flavors all work together.
Exactly. And a chef relies on experience, years of it, to really master their craft. Investors need that same deep understanding of the markets.
And Marx actually provides a framework for that. He outlines key relationships that can guide our decisions, improve our chances of success.
Okay, break it down for us. What's the first relationship we need to understand?
Well, the core of his philosophy is that relationship between price and value. He believes the most reliable way to make money is buying assets below their intrinsic value, selling when the price goes above.
We talked about that earlier with the Nifty 50. Even great companies can be bad investments if you pay too much. But figuring out that intrinsic value, that seems like the tricky part.
It definitely takes work. You need thorough analysis, a deep understanding of the business itself, and the ability to see past the market noise and hype. And even when you're right about the value, you need patience. Sometimes it takes a while for the market to catch up.
So you have to be confident in your analysis, even when the market doesn't agree with you in the short term.
Right. But it's also crucial to understand those psychological and technical things that can push prices around in the short term.
Market sentiment, things like that.
Exactly. Momentum, trading patterns, they can all make prices deviate from their true value.
Which is where the opportunities are, right? If you can spot when the market is being emotional instead of rational,
you can find those mispricings. But you got to remember, these forces are powerful and unpredictable. They can last a long time.
So you could be right in the long run, but still see your investments go down in the short term.
It happens. That's why Marx is so big on that margin of safety. Buying below intrinsic value to give yourself some cushion when things get volatile.
That buffer zone.
Yeah. And that's also why it's so important to understand those market cycles. Recognizing where we are in the cycle, whether it's a time of crazy optimism or fear, helps us decide when to be aggressive, when to play defense.
Which connects back to risk and return. As Marx reminds us, just because something is riskier doesn't automatically mean bigger rewards.
Just a chance at a bigger reward, and a higher chance of losing too, of course.
Right. He really pushes us to think about more than just volatility when it comes to risk.
There's so much more to it. The risk of losing everything, underperforming, making career-damaging decisions. Marx believes those skillful investors, they can manage all of that while still getting great returns.
It's finding that balance.
He calls it asymmetry in performance.
where the gains outweigh the losses over time.
That's it. It takes more than just stock picking, though. It's about understanding market psychology, managing risk well, being patient. Sometimes it means going against the grain, being contrarian, acting when you see a mispricing.
Marx also talks about knowing what we don't know, right?
Oh yeah, he's skeptical of anyone who claims to have all the answers, especially when it comes to predicting those big macroeconomic events.
The economy, interest rates, things like that.
Those are tempting to try to predict, but he says they're just too complex. Better to focus on what you can know, like the fundamentals of individual companies or industries.
Focusing on what's actually knowable. It's a big difference. And even when we have great analysis, there's always that element of luck.
True, true. Not every success is pure skill, and not every failure means you messed up. Sometimes it's just the roll of the dice.
But that doesn't mean we just throw up our hands and say whatever happens, happens, right?
Of course not. We follow our process, control what we can, keep learning.
Which brings us back to that idea of defensive investing.
Right. Not about avoiding every bit of risk, but making sure those losses don't destroy us.
Protect what we've got.
He says it perfectly. If we avoid the losers, the winners will take care of themselves. Play the long game, stay consistent, and let compounding do its work.
It's like that saying defense wins championships.
Yeah.
So not just about making the right moves, but also about avoiding those really big mistakes.
Love it. And with everything we've learned from Marx, he really emphasizes that this is an ongoing process.
Not a one-time thing.
He pushes us to keep challenging what we think we know, keep searching for new information, constantly refine our approach, that growth mindset.
Never stop learning.
He also makes it clear there are no shortcuts in investing.
No easy path to riches.
It takes work, dedication, a willingness to learn from both our wins and our losses.
And humility, right. Knowing that we don't have all the answers, the market can always surprise us.
Absolutely. But by really internalizing these principles, the second level thinking, that focus on value, the risk management, being a contrarian,
we can face those market challenges with more confidence, less fear.
That's what Marx gives us, not just a rule book, but a way of thinking about the markets.
A set of guiding principles to navigate this complex, ever-changing world.
He wants us to be thoughtful, disciplined, adaptable investors.
Able to reach our goals, build that financial future we're working towards.
Exactly.
So as we wrap up this deep dive into Howard Marks' The Most Important Thing, I'm left with one question for everyone listening. Where do you think we stand in the market cycle today?
Ooh, that's a good one to ponder.
What are you seeing out there? Euphoria, dangerously high risk, tons of opportunity. There's no easy answer, and as we've learned, the market is always full of surprises. But by using these principles, the second level thinking, the focus on value, the careful risk management, that contrarian mindset,
we can navigate the uncertainty and make good decisions.
that's the heart of what Howard Marks is teaching us. It's not just about making money. It's about understanding the forces at play, making those informed choices, building that solid foundation for success.
Well said.
And that, my friends, is a wrap on another deep dive. Thanks for joining us.